Let's talk about some energy stocks. A bet on U.S. energy stocks is a good bet. Companies are freed from ESG mandates, so says the founder of Strive Asset Management. Vivek Ramaswamy is here. He joins us. He's got a new Wall Street Journal op-ed out with David Sokol called Why We're Bullish on Energy Stocks. It's nice to see you, sir.
Good to see you, Andrew.
Let's hear the argument. And the question I would ask is, on a relative basis, given actually the Inflation Reduction Act, which I look at as a climate act of sorts, whether you think that's a good thing or a bad thing, we could debate. But given all the money that's going to actually pour into all sorts of clean tech, the question is, if you put $1 into fossil fuels or something like that, or into one of these sort of clean tech efforts, if we talk about it 5-10 years from now, who's going to have more money?
Yeah, it's a great way to put the question, Andrew. I mean, I think that it doesn't have to be an either or, but the way we look at this from a macro perspective is that we're in the beginning, in the middle stages of a great reversal between the fortunes of U.S. technology stocks over the course of the last decade and U.S. energy stocks, which I think are looking at a different era in the next decade. And the interesting thing that happened from a 50,000-foot perspective is that from 2009 to 2021, we were in a period of chronically low interest rates, which tends to favor tech, or anything that rhymes with tech, from biotech to clean tech. What happens is investors ascribe a lot of value to distant, uncertain cash flows in the future when cash is yielding low amounts in the bank today. Yet over the same period that investors were willing to grant that fortune to technology companies, they said that, you know what, fossil fuels and their profits are going to fall off a cliff after 2030. And so there was this great fortune for the U.S. tech sector while the U.S. energy sector flatlined or even was down over that period. I think that dynamic is now changing with a few factors that have become apparent this year. First of all, soaring inflation. Keep in mind, energy stocks do well in periods of commodity prices being higher, against the backdrop of rising interest rates to fight that inflation, which of course disfavors tech stocks. So what we're saying is we predict we foresee the possibility of a rotation of capital from U.S. tech stocks to U.S. energy stocks, from the tech sector to the energy sector. And the thing this year, Andrew, was that the Russia invasion of Ukraine woke everyone up to the fact that, you know what, fossil fuel profits aren't going anywhere after the year 2030. They're here to stay for some time to come. So that's the basic view.
Let me ask you, let's take out the even clean tech stuff. If you had money in an Apple or an Alphabet, you take that money and rotate it into fossil fuels right now?
Into broadly the U.S. energy sector, I think there's a strong argument to be made for it. And the reason why, Andrew, is I think that that's a massive supply-demand imbalance is not going anywhere for global energy. But there's also a number of factors coming up, even in the relative near term, to spike that supply-demand imbalance. I mean, you take a look at, for example, we'll see what happens in China. But when those coronavirus restrictions are lifted, if and when they're lifted, Xi Jinping now has a firm grip on power. That's a demand shock, possibly coming at the same time as a new supply shock to the system when the EU ban on Russian oil goes into effect. The U.S. Strategic Petroleum Reserve is at the lowest level it's been since 1984. The best way for them to fill that is to buy fossil fuels, to buy oil from U.S. fossil fuel producers. And by the way, the Middle East, as we've seen recently, is somewhere between unable and unwilling, if you're Saudi Arabia or the UAE, to step up and fill that void. And so I think the basic issue, Andrew, is we've had this ESG-informed investment consensus over the last 7 years, which says that fossil fuels are falling off that cliff after 2030. That means the so-called terminal value, the value in the distant future of these fossil fuel profits are effectively implied for a long time at zero. That's changing. And so I think that as that rises, you could see price earnings multiple expansion in the U.S. energy sector.
I'm not even going to debate this point with you. I agree with you that long term, or at least over the next 10 years, there will be a market clearly for fossil fuels, if not for 20 or 30 years longer. The question is, from a tailwinds perspective, given actually the injection of money that I was arguing the Inflation Reduction Act ultimately is for those kind of companies, whether those will actually turn out to be better investments than fossil fuels.
Yeah, I don't think that money raining from on high, like manna raining from heaven from the federal government, changes the underlying fundamentals of where we are in global demand and need for fossil fuels relative to the lack of readiness of wind, solar, and other technologies to fill that same void. That's my view, Andrew. And I think that that's been laid bare this year with respect to a disruption of less than 10% of the global market share for hydrocarbons coming from Russia. If that was able to wreak this much havoc on energy markets, I don't think we're moving to a 100% transition anytime in the foreseeable future.